Welcome back to TFR. From time to time, we like to feature some of the greatest hits of all time. Today is one of those days as we dig deep into the archive and replay one of the most popular episodes. We hope you enjoy it as much as folks did the first time around. Here it is.
Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Ben Sun joins us today from New York City. He is co-founder and general partner of Primary Venture Partners. Primary invests in visionary founders building category-defining businesses by going beyond capital. Companies they've invested in include Coupang, Chief, Slice, Jet.com, and Noom. Prior to Primary, Ben was a co-founder of LaunchTime, an incubator and investor, and co-founder of Community Connect, one of the first social networking companies. Ben, welcome to the program.
Thanks, Nick. Thanks for having me.
I think a good place to start might be your founder journey. Can you tell us, a bit about that experience?
Yeah, I was born and raised in New York and went to school in Michigan for undergrad. And then after college, didn't know what I was going to do in life. So my brother was 7 years older, was working in investment banking. And he said, if you have interest in business, why don't you do an analyst program? And so I applied, got into an analyst program at Merrill Lynch. It was 1995. And so when I was going through training, Netscape went public. And I think I remember asking one of my analyst classmates, what's a web browser? So definitely was not, into tech or technical at the time. And you just saw the opportunity of what was happening just with kind of the rise of commercial internet and internet IPO. So I joined the tech group and we started kind of pitching internet IPOs at the beginning of the dot-com boom. And, I was doing that for 2 years as an analyst and just kind of caught the bug. And so I left the analyst program and decided to become a founder. And so in 1997, I started actually working on really an early social networking site out of my one-bedroom apartment in Midtown in 1997, which was, years before Facebook and even MySpace. So the term social networking hadn't been even coined yet. I tell people in, I think 1997, I think there were only 2 or 3 digital cameras on the market. And so I tell folks, imagine launching a social networking site where you had to ask your members to mail in their photos so you can scan it in for them. So yeah, it was not easy, but we launched an Asian American social networking site called Asian Avenue in the summer of 97. And I started getting all this traffic, and I had spent, I think $5,000 of the money I had saved up from my analyst bonuses to buy a server. And I think by the time we had like 40 people online simultaneously, the server crashed. So, wow. It's before cloud computing. And so basically I was like, okay, I got to buy more servers. And so I raised money from friends and family, like small checks from a whole bunch of people. But it was the kind of money that your like mom and your brother give you because they love you. No, they're like, when are you gonna go get a real job again? The
donation, right?
Totally a donation. And so I raised $300,000 just to buy some servers. And I said, okay, well, I'm starting to at least manage the traffic I was getting, but it was still growing really quickly. And I was like, okay, I got to raise more money. And so there was no New York tech ecosystem, basically. So there were no angels or VCs here at the time. And so I said, okay, like, let me go out west and try to raise money in the Valley. And I went out and, try to get my way into some meetings, barely got any meetings. If I got some, I was basically laughed out of the room. So it was like, a New York guy coming to the Valley, they would try to raise money back then. That was weird. 2, the term social networking hadn't even been coined yet. So just trying to understand what we were doing was, really kind of foreign. And then 3, in our plan, it said we were going to launch an African-American site next. And people looked at the plan and they were like, Black people and the internet? And people think that's weird now, but I tell folks on the cover of Business Week magazine that year, one of the cover articles, the headline, like the cover article headline was, "Will women be online?"
You're kidding.
No. So if they were questioning if women were going to be on the internet, the thought of black people and computers, they're like, hey, dude, you left your moon boots back on your spaceship. So
it feels like a generation ago, but it wasn't. I mean, it wasn't really that long ago.
It really wasn't. It really wasn't. But that's, what we were dealing with. I mean, it was so new. And it was almost a perception that it was just like white male nerds that were on the internet. And even the thought of like, will this be for the masses was still like misunderstood or not completely bought in yet. So anyway, came back, couldn't raise any money. We bootstrapped the company for 2 years and living like poor college kids. And then I basically got lucky. I was introduced to this guy, Bob Goldhammer. He used to be the vice chairman of a pretty big investment bank called Kidder Peabody. Bob had retired, but he was investing in helping some startup companies, not in really tech, in things like biotech and other areas. And Bob met up with me at my apartment, sat down with me for 4 hours. And by the end of it, he goes, I'll invest and I'll get my friends to invest. And so Bob and his friends put $5 million in the business.
Wow.
It was big deal going from that to the apartment, working out of a 1-bedroom apartment to raising a real round. And then we launched in 1999 our African American site called Black Planet. And I had $1 million set aside for a marketing budget. But after we launched, by the second or third week, I remember being like, okay, don't touch that $1 million because we need it for more servers. And so we started getting all this traffic, and I was like, it was all word of mouth. So I would get calls from my friends and they'd be like, hey, I heard your ads on Hot 97, the hip hop station in New York City. And I'm like, I'm not running ads on Hot 97. And it's because all the DJs joined Black Planet and they were giving like shout outs to Black Planet members on the hour.
That's the best. Free marketing.
Oh, free marketing. Or like another friend called me and they'd be like, how much you have to pay Kanye, Kanye West to rap about Black Planet? I'm like, I don't know Kanye. And Kanye's breakout album, College Dropout, he had a song where he raps about picking up women in college on Black Planet with Talib Kweli.
Wow.
And so Black Planet became, top 25 in traffic. It became like number 1 or number 2 in stickiness, depending on the month. It was us or eBay. And so suddenly, like, we kind of proved there were Black people on the internet. And so,
amazing.
And so it was now the peak of the .com boom. We raised $20 million of venture money from Comcast, Sandler Capital, Inside Ventures. And then I think 2 or 3 weeks later after we raised, the .com crash started happening. And I was like, okay, after a couple months into it, I was like, we're not going to be able to raise another round again in the foreseeable future. And so fortunately, we had a lot of traffic and it was an ad-supported business with not enough of a ad market to sustain ourselves to be profitable. And so I said, well, what's profitable in consumer internet in the year 2000? And you can imagine there weren't many companies that are profitable in consumer internet in the year 2000. So, but one company that was profitable was Match.com. Match.com had launched in, I think, 94, 95 and got profitable pretty quickly. And I was like, well, I have people on the site like Kanye that's trying to figure out who's single and like randomly flirting with people, trying to figure out who's single and stuff. And I'm like, I bet you if we let people create a dating profile, we can charge a subscription, right? So we can take this free social networking site and convert it and monetize it through subscription. And we'd have no customer acquisition costs because we had all these millions of people on the site using the site anyway, making friends and flirting. And
love it. Social is top of funnel for the dating site.
Totally was. And so we launched our dating area in 2001 and it saved the business. And so the business became profitable. So we were doing about $20 million in revenue and we were doing about $6 million of EBITDA. So profitable. And this is still like pre-mobile, probably half our users on dial-up. So really hard to monetize back then. But we were one of the few companies that sort of combust, right? So you can imagine like the VCs that backed us, it was like the Asian, Black, and we also launched a Latino site. The Asian, Black, Latino community site is the one that worked out.
Wow.
So anyway, I ran the company as CEO for 12 years. We had about 130 employees in New York City. And then we sold the company in early 2008. And so we sold it. It was a good exit. My seed investors made 30 times their money. We got acquired by a large African-American, actually the largest African-American media company called Radio One. Black Planet ended up being about 80% of our business. So they really bought it for Black Planet. And then I wasn't locked up. And so I stayed around, helped with the transition for about 8 months. And then the financial crisis hit. And I said, probably a good time to take a break. So it was a 12-year run. I was tired, the financial crisis. I was like, you know what, I'm going to take a year off, travel the world, try to figure out what I want to do next. And so I spent that year traveling the world, kind of came back and said, my heart's in early stage startups. But, when I look back at my journey, I was like, I love the early parts of the journey. I just wanted to try a different path where I was going to help other founders get their companies off the ground instead of me being the CEO founder myself. And that's how it led me to started kind of investing in and then also incubating businesses. And this started about 2010.
Yeah, I want to talk about Primary, but before we do so, I'd be curious to get your take on what it's like to start a company now versus when you did. We've had a number of folks on the program that say it's so much easier now, and you can see that with speed to scale and the number of startups being founded, and you don't have to purchase servers, right? You can just get easy access to cloud. But then there's others that have come on, like Jeff Clavier was on, and he said it's much more expensive to create a startup now than it was 10, 15 years ago because of talent. What are your thoughts on, I guess, the major differences and challenges now versus when you started Community Connect?
Yeah, it's interesting. I mean, people have come to me just because of Community Connect and said, they're working on like a niche social networking site or niche, whatever. They're like, oh, I wanted to learn from your experience of doing that. And I was like, you have to understand, it was so different then in terms of the market and the competitive landscape. When we launched Black Planet, I tell people a big reason why the African-American community embraced it was that there was no good social networking site at the time for white people. Mm-hmm. Right. So when Black Planet launched, like people were getting like tattoos of the Black Planet logo on their body because they were like, wow, like we have something that no one else, especially like what non-Black people have, especially white folks have, versus like in almost everything else, like the African-American community almost felt like they got the short end of the stick of whatever it may be, like, oh, the cable channel or whatever. Like it wasn't something that felt like, wow, someone's really kind of invested and brought something to the table that, would make white people envious. So it's funny, like I think back then, if you can build a great product, you usually found your way through distribution and would get customers. Mm. And so I felt like back then, if you thought about product 90% of the time and distribution 10% of the time, you would probably win. And that's how my mindset was, like just product obsession, product obsession, product obsession. I think now, and this is not always the case, but I'd say now when people come to me and with a business idea and they're thinking like 90% product and 10% distribution, I'm like, you're most likely going to fail because consumers just have so many options out there. And if you're not spending at least 50% of your energy thinking about distribution, I think you're going to struggle. And so that's, I think, a key difference. You can kind of argue about, cost to people, but I think, trust me, we racked and stacked servers and the cost of bandwidth and storage. I mean, it was astronomically higher than it is now. So yeah, some of those arguments on people, but I think on underlying technology and cost structure, it's definitely much better than it was then. But I'd say the biggest change in the challenge is that there's so many companies, so many startups, so many options, and to stand out, you have to not only build great product, but you have to also master distribution.
Is there a bias at Primary toward consumer investments?
No. I mean, the journey for me on from going where I was to Primary was that, after I sold Community Connect, and I decided to initially personally invest in incubate businesses, and I just created a kind of an entity called Launch Time and said, I'm going to put my, do some work here. And luckily had some success there. So, I met a guy playing a game of pickup basketball at Stuyvesant High School in New York City. And this guy was chatting with me. Hey, what do you do for a living? We kind of got to know each other. He was this entrepreneur. He had actually ran a small magazine business. He had sold it and he was trying to figure out what he wanted to do next. And he was thinking about obviously tech instead of a print magazine business. And so, we would meet for like a year or so, batting ideas around didn't land anything. He ended up going to business school. And in his first semester in business school, was fortunate to help him with an idea that he was thinking about doing, which was this company, Coupang.
Wow.
And so helped him think through the idea, bombed and moved to Korea, started it. I invested. I was fortunate to have him ask me to join the board and just started helping him with the business. And that business started as more of a local daily deal site, similar to a Groupon in Korea. And if you now fast forward to where the business is now, it's basically 100% out of the local daily deal business. And it is part Amazon, part Instacart, part DoorDash. It's a $70 billion market cap business. And there was no plan.
In Korea, right?
Yeah, it's been unbelievable. And so, when I met Baum in the beginning and when I vested, there were none of those plans to go into any of those businesses. And we're 100% of the business that we were in originally. The one common thread of that journey is, Baum's the founder and CEO and has driven that business to where it is now. And realizing that probably the biggest determinant of a company is definitely the founder. And so getting back to your original question of what do we focus on, consumer or B2B? We're open to all sectors. I think we realize, my partners and I realize that what we really want to bet on are people. We want to bet on great founders, hopefully playing in very interesting markets. And if you bet on those great founders, there's a good chance that they'll make something pretty special. And so that's our lens. And that's why when we set up Primary, said, hey, we're going to focus on New York City and be sector agnostic, be business model agnostic. But the one thing we're not agnostic about is, our search for great founders. And we think seed investing is much more about being talent scouts than business scouts. And so we said, look, by being born and raised here, having my whole career here, my network runs deepest here, have an advantage as a talent scout probably makes sense of being New York focused. And that's what we really kind of anchored on.
So are you leaning into this scalable sourcing strategy of playing pickup basketball games?
As I've aged, my pickup basketball game has gotten a lot worse and more injury prone. So in the key man clause or agreement and our LP agreement, I might need to stop playing soon.
I got a text from one of our venture partners yesterday, and he was in two full leg casts, and I said, the skiing in Jackson has to stop. We can't do this anymore. Too old.
Yeah. Yeah, that's the price you have to pay.
But it is a New York City focus, yes? At Primary?
It is. Yeah, it is a New York City focus. So the journey was, I was personally investing and incubating some businesses in Coupang, where I met Baum in New York, but business obviously went out to Korea. Along the way, I was still investing in, incubating some businesses here in New York. And so got to invest in companies like Noom and Yipit and a number of other ones, and had realized that the caliber of talent in New York City had gotten dramatically better. And even in journey with Coupang, I was getting people that were in the New York tech scene helping me with the business. So I knew Mark Laurie when he was running diapers.com, and I had a business I incubated that had a partnership with diapers.com. And so Mark and I got to know each other. And when Amazon acquired diapers.com, I knew Mark was locked up, but I also knew some of Mark's best lieutenants. So, I grabbed 3 of Mark's best lieutenants and kind of signed up as advisors, and they helped us with kind of charting our path on some of the initiatives that we were doing at Coupang, and especially kind of in our baby category. And had realized that in working with these people that the caliber of talent in New York City tech had gotten dramatically better. And I tell people the biggest catalyst to that was in New York City tech was the financial crisis. When I left investment banking in 1997, I remember telling my friends, I'm going to leave Merrill to do a tech startup. And my friends were like, what? You're going to leave investment banking to a tech startup? That's a terrible idea.
The dream is to work at,
they're like, the dream is to work at Goldman or some PE shop or a hedge fund or whatever. And that's how the mentality was. And when I was running my startup, it was so hard to recruit. There wasn't a great pool of talent. People wanted to work in banking or be corporate lawyers or consultants. And then suddenly the financial crisis hit. And, the whole mindset changed, right? Before the financial crisis, if you ask somebody hey, where do you work? They'd be like, puff up their chest and say, I work at Goldman Sachs. And then during the financial crisis, you'd be like, where do you work? And they'd be like, I work at Goldman Sachs. It's like, you almost took down our entire economy. Right? So it just became less noble work, less lucrative, less inspiring. You hear stories about people make money off of flash trading, right? Like, is there any real value that gets produced? No, they're like, cheating the system. They're cheating the mom and pops. I mean, like, is that really what you want your life and legacy to be about? Right. And people are realizing that. People are smart and hopefully with good intention. So people started leaving, or people stopped wanting to work there. So post the financial crisis, if you look at the wave of entrepreneurs that hit the New York City tech scene, Mark Lorry used to work at Bankers Trust in sales and trading. And he left, Bankers Trust to eventually buy packs of diapers from Costco. And he was shipping out of his garage in Montclair, New Jersey, when he started diapers.com. Dave Gaboa left Allen & Co. as an investment banker to start Warby Parker. Alexa Von Tobel was at Morgan Stanley, and she went to start LearnVest. Jason Finger was a corporate lawyer pulling out menus from his desk late at night, working his corporate law job and being like, why can't I order food online? And started Seamless. So you suddenly saw these people that left these traditional kind of New York industries that were this kind of black hole of our talent. And then suddenly they started emerging and started doing startups. And then the people that worked for them were also super talented. So, this one guy, Nate Faust, was the head of ops for diapers.com. I met Nate as one of those advisors I was talking about. And Nate, Princeton undergrad, works in consulting, goes to HBS, Harvard Business School, graduates HBS in 2008. Not a good time to graduate, right? And instead of like getting a job at McKinsey or some hedge fund, he interviews with Mark when Mark Lorry, when Mark's office was above a lamp shop in Montclair, New Jersey. Right? So Nate is graduating from HBS and interviews, and Mark doesn't know anything about e-commerce. And then Mark throws him in a ops role. And then eventually Nate basically runs ops for diapers.com. And then, I got to then get to know Nate, and he helped us with a bunch of stuff. And then he co-founded jet.com with Mark. So that was basically the bet, was like guys like Mark and Nate that were part of this new tech ecosystem and talent pool. Just over time, they were going to build big outcomes. And so at that time, post the financial crisis, if you think about it early on, Tumblr was the big exit in New York City. I think that was 2013 or 14, right? For $1 billion, New York's biggest exit to Yahoo. And people were questioning, will there be another big exit in New York City?
I hear you. I'm in Chicago, and for many years, everyone just talked about Groupon. And it's like, we've moved on from that,
Totally. And they don't see the momentum that happens. It's like when the talent starts coming into the market, success is going to breed success, and you're going to see it happen. And that's what happened to the Valley, right? So it's going to translate the same here. And that's basically what we saw. And so when we saw that first wave of entrepreneurs hit, we said, wow, New York's going to hit this inflection point now. And over time, it's going to get bigger and bigger and bigger. And that's why for primary, we said, well, like, let's go fish right in our own backyard where our networks are deep. Let's have that super focus on New York, because if we can be talent scouts, we can build relationships with the people that work at a Datadog or a Peloton or a jet.com. And when they go off to start companies, we know them, we trust them, we've collaborated with them, and hopefully we can help them build special businesses. And that's why the strategy has been this New York focus, is that we think about it in terms of let's go play in a market and try to win a market where we can build the best relationships and back the best talent.
Ben, I'd love to get your take on all this buzz around Miami, right? I think the foundation of a lot of great tech ecosystems is this talent pipeline. You've talked about being a talent scout yourself. Is this a viable tech center, or is this hype?
Well, I think all markets are, I would say all markets. I think, is it a very livable city? Livable meaning, like, do people really want to live there? And I think, when people question New York, I was like even, during the pandemic or the financial crisis or 9/11, it was always about like New York's demise. And I'm like, New York's an amazing city to live in. It really is. And ultimately, if people want to live there, make friends here, build their community here, have family here. I mean, it's, having those roots and that basis is the most, I think, important starting point. Then if talent comes and you can kind of put fuel to the fire to it, I think you can build like a great tech market in any place that's incredibly livable and where people really want to aspire to be in. And so I think Miami does that fit the bill? I think definitely potentially. I think there's a lot of really great things about Miami, and it's going to fit the lifestyle and what people would like to experience. And, I think I'm definitely rooting for it. But at the same time, I think New York is just at the very beginning, and we're going to see that market continue to, it's been exploding, and it's going to continue to take its course.
So give us the 1 minute overview of the thesis at Primary. Stage sector, clearly it's New York City, but can you give us a sense for, the thesis and the investment focus?
Yeah, for sure. So we started the firm in 2015. It was a $60 million fund that we first started off with. Now we're on our third fund's a $155 million fund. It's focused on seed, so it could be pre-seed, seed, these bigger seed rounds, mango seed, whatever you want to call it. But usually I would say like $5 million round is at the top end. And it could be as small as whatever, $500K or $1 million kind of pre-seed round. We invest in New York City. We are sector agnostic. We invest in consumer and B2B. Right now, our portfolio is probably 60% B2B, 40% consumer, but it's not kind of weighed with any intention. We just want to back great founders and opportunities. And so beyond that, our real kind of differentiation is we're not a high volume seed shop. We don't cut a lot of checks around. We do roughly about 8 to 10 deals a year. So we're pretty selective. But at the same time, what we bring to the table is a pretty large team. So we have over 20 people. Half the team is on what we call the investment team, and the other half is what we call our portfolio impact team, where we have at the senior level operating partners. So these are C-suite level execs that were startup operators. So, Cassie Young was chief revenue or chief customer officer at CM Group, which is now a $200 million plus MarTech SaaS business. Rebecca Price was chief people officer at businesses like Capsule, Enigma, Sailthrough. So those are the type of caliber of people that we have at the operating partner level. And then below them, they have teams of people around things like talent and recruiting, market development, strategic finance, et cetera. And so this team is really responsible for helping our companies after we invest. So we really dedicate real operators to help and where they can work on site, dive deep, and hopefully have a really meaningful impact. And they're trying to have a meaningful impact of helping our companies get from seed to Series A. And so one thing I want to make sure is clear is that we're not here to run the companies for the founders. Why we do this is that we're trying to provide as much value as possible, because we realize that we can if we are really helpful, that will win us the right to work with great founders. And that's what we're really trying to do. We're trying to work with great founders, and by just doing more work and getting our hands dirty and hopefully having a real impact, we'll win that right. And so is
that mostly strategic work? Is it sweat? Is it help with talent recruitment? What areas does the team really contribute?
It's all of the above. So Rebecca Price has a team of folks on the talent and recruiting side. And so why do talent and recruiting? Well, if you think about a company's journey from seed to Series A, and you ask yourself, why do a lot of companies fail? One of the big reasons, and having been through the journey, is definitely the talent you get in the very beginning. Because you think about it, it's like you raise a seed round, you're going to go from 5 people to 12, right? You go from 5 people to 12, you're not hiring a chief people officer. You're probably not even hiring a head of recruiting, right? Because you're only going from 5 to 12. But yet every single hire is probably a single point of failure and is probably really, really critical, right? So you raised enough money to say, okay, I got 2 years of runway with 18 months before I then had to go raise my Series A to give myself like 6 month, of a cushion. In 18 months, if you think about let's say you have to build an iOS app. By the time you hire an iOS engineer, you realize if they're bad or good, you maybe have to then fire that iOS engineer and then replace that person. You're out of runway. And so these are the common things that happen to startups all the time. Yet when you look at what they have to do in a recruiting standpoint, you're like, well, a lot of them don't have recruiting backgrounds. A lot of them don't have any type of recruiting resource. They're left their own devices. They have a company with no brand, right? it is really hard, especially in a competitive market where there's a war for great talent. We're talking great talent, as you know, is a game changer for any company. Yep. So if we can give you that leg up on getting great talent, we should be doing that. And the reason why we're able to do that is, one, we have talent operators who've done it before, that's done it for startups at the startups they work for. So one, they bring the skill set. But then two, we actually have leverage of our time. If our entire portfolio is in New York City and they're trying to hire talent in New York City, then every person that we meet as a potential candidate, if it's not a fit for company one in the portfolio, it could be a fit for company 2, 3, 4, 5, 6, 7, 8, 9, 10, whatever. So we have 60 companies in our portfolio. So it's a real leverage of our time. It's like you're creating a two-sided marketplace in recruiting. If you don't have a lot of supply, you're less efficient. We have supply. And so we do things like that when we think about, well, if we have an edge and can have leverage of our time and our resources, we should be doing that. And if it can have a big impact in your company. So that's an example of something that our portfolio impact team does. So they literally are often working on site at our companies. This is pre-pandemic, but now they're starting to do that now as the things open up, and, sitting down with the teams, understanding the culture, the needs, the people, letting them think through it, and then helping them run their processes as well as source. And it's been super impactful and a big reason why the companies that we put term sheets in front of, choose us.
So Ben, pre-investment, you told this story about your interactions with Baum and Coupang, and it was a continuum over time and a lot of discussions and strategy. I'd be curious to get your take on how collaborative is sort of that formative idea stage between Primary and the entrepreneurs. I imagine some of them come, they're ready to raise, and if it's a great fit, you invest. But in other circumstances, ideas may not be fully fleshed out. How much of a role do you play in some circumstances, working on the idea with the founder and, collaborate and kind of, find the right market and the right opportunity?
Yeah, it's funny, Nick. I mean, you being in the business, that a lot of firms have a CRM. They look at their funnel, they track like what deals are happening and what's happening in that funnel. I tell people like our CRM, our top of the funnel is really people. Right. So we don't even if we identify great founder talent that's even just thinking about starting a company, we log them into our system. And we're always thinking about, okay, who on the team is tracking them, working with them, seeing where they can be helpful, helping them think through ideas, et cetera, connecting with other people on the team that they think they can hopefully be helpful there. And we think that's a really important part of our kind of journey as investors, because we realize that, especially as seed stage investors, this is a 10-year, maybe more journey as partners with those founders. And that working relationship, that collaboration should be a huge, determinant of whether or not we should be doing the deal. So we really want to get there as early as possible, working with them, that partner, thinking through the ideas and grappling with it. I mean, that's the kind of stuff that you kind of then form an opinion on, hey, do I really believe in this founder? Right? Because it's not about them listening to our ideas. It's like, how do they process it? How do they rationalize it? How do they think through it? How would they go out and do it? It's seeing how they would approach it that gives us confidence, okay, they're going to figure it out. And that's how the lens that, when people ask us, how do you evaluate founders? It's almost like a pretty easy, question that you have to ask, which is, would you bet against that person? Right? There's certain people you meet and you spend time with, you're like, you know what? That Nick, I wouldn't bet against that dude. He's going to figure it out. Right? I remember meeting one investor that worked at DFJ before it changed its name. And I had met Steve Jurvetson when I was raising money in my first startup, and they never invested. But I met Steve. I hadn't heard about Steve in a long time. He was on the cover boy of the whole VC scene when I was first doing my company. And I was like, I don't really read a lot about Steve or see a lot of articles I used to see about him. And this one when I worked for him, he's like, yeah, he kind of just wants to work with guys that he's had really strong relationships and believes in him, that he believes in, like Elon Musk.
If only we were all so fortunate.
But I bet you Steve met Elon early and he was like, I wouldn't bet against this guy. So whatever Elon does, I wouldn't bet against that guy. It's like, yeah, you want to build a rocket ship? Yeah, I wouldn't bet against you. So there's just certain people that you meet and get to know over time. And you're like, okay, I feel like this person's really special. I wouldn't bet against them. And so that's how we approach it. And so I think that process of collaboration, partnership is an incredible way of like any investor to get that assessment. But most what makes it challenging in this market is that deals are happening so fast because it's so competitive. And I think a lot of investors are like, hey, I have to use speed as an advantage, right? And so them doing lighter diligence and just going and saying, okay, I want to do this. I'm really willing to move really fast. I think that could be dangerous for our industry. That collaboration, that partnership then could fail and break and it could be bad for both sides. So those are one of the things that's a recent thing that definitely me and the rest of the partnership has been definitely thinking about and concerned about.
So the talent scout and the talent cultivation side of it, people you're not betting against. I'm curious how that squares with like market size and market opportunity, right? We've had a number of folks on the program that say, it's all about the market. The team is important, but there's sort of a base level of competence. And then many others that say it's just all about the team and the best teams will find their way to the best markets. Where do you stand on that, and how does that square with kind of the way that you look at talent?
Yeah, I mean, I would definitely, I tell founders I work with, it really makes a big difference if you choose the right market. And the right market can mean a lot of things. It could be size. It could be, what are the tailwinds associated with the market? It could be small now, but growing really quickly and you're catching the tailwinds on it. And that makes such a difference, instead of like choosing a smaller market or a market with a lot of headwinds. And so as a founder, it's like, I tell people like my startup, just given the timing, we made it work, but it was a lot of really tough execution. And it was like squeezing water out of a rock. It's really hard. And then you work on a business like Coupang, and it was like squeezing water out of a big wet sponge. So you're just like, and it's not to say that Baum hasn't done unbelievable execution. He has, but he's done it in a great market and with a great model.
Right
timing, all of it. And so it was such a huge advantage. And so when I tell that to folks, especially entrepreneurs who played in tough markets, they get it right away. They're like, oh yeah, I totally get it. And so your question of how much that means, I think we definitely would say, probably the founder and entrepreneurs, it's like 80 and 90%, but that 10 or 20% about the market, it doesn't have to be like all of it lined up, but we need to feel like, okay, there's enough of a market or the right tailwinds that we think you have a better chance of success. Now, as we're thinking through the business models and so forth, if you find out that like you don't believe in the business model or the approach that they're going with, but you believe in the founder so much, we've had those situations. And ultimately, I think we've come to conclude that like we shouldn't do the deal, because if you invest and from day one, you're just trying to tell that founder not to do that approach or business, it's just going to be a bad partnership and probably not healthy. And so during that, like, as you collaborate and you're trying to understand if you should invest and you're pushing and you're realizing like, wow, like the direction where I think it really needs to go, they're just not at all aligned with. And I think it's a major mistake. Even though we really like and respect the founder, we just say, let's just step away for now. It's not the best for both sides, but stay close to that person, because if they pivot, we may want to jump all over it at that point. So that's often like how we approach it.
Yeah, there's this question we ask ourselves in IC committee before we make an investment. Could you put this business and founder in front of a tier 1 Series A VC tomorrow, and the only thing that's missing is traction? And I've found, in my career, if you back businesses that you got some concerns about, it becomes this painful exercise to pitch them to potential partners of the future when, you've got your own reservations about the business potential.
Yeah, that's right. Yeah. So Nick, I mean, definitely when it comes to thinking about the market and the business model approach, I think the thing that you flagged there in the Series A is financing risk, right? So if we're having a struggle with the market and the business model, we know other investors will, it's like, well, when you go raise that A, when you talk about traction, you have to have like crazy good amount of traction. And, that's just so hard to do versus like some people that love this market and love the business model you're approaching. Even if you have a little bit of traction, you're going to get, a dozen term sheets, right? So, financing risk is a real factor in this game, as you guys know, by even asking that question. So totally agree.
Ben, you wrote this tweet, quote, "There is no longer such a thing as proprietary deal flow in VC. It's now more about winning a deal versus picking a deal." I'm curious, what has changed? Is it supply side of capital at seed? Is it, other factors? What prompted the tweet?
Yeah, it's funny. I mean, it's, you think about venture, 20 plus years ago, which is this cottage industry, and deals that were getting done, there was only like one term sheet on the table if you were lucky to get. If you're in venture now, and I'm sure you probably see it, Nick, if the company doesn't have more than one term sheet, that may be the unicorn these days. So that's the reality of the market. And I don't think that's a bad thing. Like ventures had, great returns, especially for really good funds, and markets are efficient, and supply of capital is going to come in to establish some equilibrium here. And there's going to be increased competition, which is, I think, really healthy and what should be happening. With that being said, yes, there's going to be multiple term sheets on the table now. And so when I think about that, it's no longer like, hey, picking the company and issuing a term sheet is really what's special, because at the end of the day, the company's going to have multiple term sheets, most likely. Now it's about like, what's your advantage about winning? And so I'm an LP in some other funds, and that's the big question I always ask. It's like, what's your edge, right? It's not about like, oh, what are you going to go pick and what are you into? I'm like, no, like I assume your, table stakes, you're going to have to pick something that's good. Like, why are they going to choose you? And if they don't have a good answer, then, I'm not interested. And I think that's the reality of where the world is now. And I think that's a good thing. I think it's all been really healthy that as more firms are issuing term sheets and being competitive and having to try to figure out how to differentiate themselves, that they are forced to then figure out how to raise the bar for themselves and for the industry of how they can really set themselves apart and provide value to the founders and the entrepreneurs. So I think this increased competition of going from just picking, but now you have to win the right to work with entrepreneurs in that deal is a good thing for a business and hopefully for venture capital and startups altogether.
So I'll put you on the spot. What's the win rate at primary, and why do y'all win going head to head against other firms?
So we track this. It's one of our KPIs, our win rate target. So it's when we issue out a term sheet, do we win 90% of the time? So it's a big goal. Like we like big, hairy, audacious goals. We're right about there. We're like mid to high 80%. So we're trying to figure out how to make sure we hit that goal. So we're all actively working on that. And so why do we win? And pretty much, I don't remember the last deal that we've done that didn't have multiple term sheets on the table. So that gives you a sense. So this is not jaded to, hey, we're picking deals that no one's around the table. And so how are we winning it? We're winning with our team, and especially what we're doing, not only an investment team, but especially on the portfolio impact team. So when we issue out a term sheet, we're not just like, hey, emailing a term sheet and just me getting on the call with somebody and walking through it. We usually issue the term sheet, say, hey, let's get on the call. Before, it used to be us going to their office, which we're going to start doing again. And then we bring like the whole team, right? So we roll in with like 22 of us. And then we not only hand over the term sheet, we go through our deck. And we customize our deck to talk about why we think we're going to be the best partner for you. And in our deck, it's things like, hey, Nick, we know, from our all meetings with you and understanding your plan and your budget, you have these 7 critical hires you have to make. Let our talent recruiting team tell you what's in our pipeline and who are the people that we can connect you tomorrow to help you with this, right? And we go through profiles and what that pipeline looks like. We have our market development team say, Nick, we know that you don't have any brand, you're just going to raise this money, but you need some beta customers for your software. Well, we have this market development team that's going to go and do outreach to these enterprises. This is how we're going to get in. This is the people that we know. And because we're calling on them with a VC calling card, they take our call. And here are all the companies that we worked with and how we've helped develop their pipeline. So when we come in, it's not, hey, we like you, take our money. It's, hey, we like you, take our money, but also this is how we're going to really help you get to your Series A in really tangible ways. And that's when our founders or the founders that we pitch are like, whoa, this is different. And then we say, look, here's the list of all the founders we work with. Go talk to them, back channel us, whatever you want to do. And we'd be shocked if they're not telling you, hey, you'd be crazy if you didn't take these guys' money and get their help. And so that's where we really kind of anchor on, and that's our core differentiation.
Ben, what do you know you need to get better at?
I think it's what we kind of touched upon earlier about a pass or a deal we didn't do. My definite style is when I have my own conviction or I have my own thoughts. I think I'm just because I'm a kind of a hard driving guy. I push with my opinion pretty strongly. And when you're trying to build a team and a culture where one of our values is a we firm, where I really want people to be owners and I want everyone to be a driver of the firm, because I think that's how we're going to become great, that it doesn't feel like it's me that's doing the driving. I want everyone driving, and I have to kind of temper my thoughts and enthusiasm or opinion and make sure that people have the space and the ability to build their own conviction and take their own risks and feel like they get my support. And so that's one big area that I feel like, as someone that's trying to grow a venture firm and scale it and make sure the team is growing and living up to their potential as well, that I needed to get better at.
And then finally here, what's the best way for listeners to connect with you and follow along with Primary?
Definitely email is ben@primary.vc. So I welcome anybody to email me. And then at the same time, follow me on Twitter, BKSun. K for Kevin is my middle initial. So BKSun on Twitter. And then also go to primary.vc. We have a newsletter that we send out, a lot of really good, thoughtful content and insights and more stories. So hopefully people will enjoy that as well.
Well, Ben, it was a true pleasure to have you. I've heard such great things over the years from so many people, and real pleasure to finally have a chance to speak with you and get some of the stories behind some of these great companies.
Same here, Nick. I really appreciate it. Thank you.
Thanks. That will wrap up today's episode. Thanks for joining us here on the show. As always, show notes and links for the interview are at fullratchet.net. And until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks for joining us.